Over the last year or two, we've seen the United States weaponize the dollar, basically saying your bank balances are frozen, and not only that, we're going to pay your bank balances to your enemy. So when you weaponize somebody's dollars, it makes those people who are not the best friends with the United States think, well, do I really want to hold all these dollars? We haven't done anything wrong yet, but who knows how we're going to feel in a year or two. We have to have a plan B. And there could be a generalized move, I think, well, there is a generalized move by many central banks now to start acquiring some gold at the expense of treasuries. And, we see that in particular with China.
Central banks are often considered the smart money in the gold market. Their sustained accumulation of gold reflects a broader strategy to diversify reserves and hedge against their own policies. Moreover, this buying activity supports prices, creating a favorable backdrop for gold investment. Many nations view gold as protection against currency fluctuations and economic uncertainty. This has led to the largest central bank gold buying spree since the 1970s. Senior wealth manager Clive Thompson said that almost 27 central banks boosted gold reserves, primarily those not aligned with the U.S. They are shifting their reserves away from US Treasuries into gold as a direct response to the US weaponizing the dollar. Japan's Treasuries holdings fell to $1.060 trillion from $1.087 trillion the previous month. Japan remains the largest foreign holder of US Treasury securities. China, number 2, cut its holdings to $759 billion from $768.6 billion in November. Focusing on China, Thompson observes that a staggering 85% of the growth in China's foreign reserves has come from gold, both through direct purchases and rising gold prices. He also notes that China's gold reserves per capita remain relatively low compared to the United States, which could further drive their accumulation efforts. Demand for gold could be driven further by a pilot program in China that allows the country's insurers to buy gold for the first time. Bloomberg cites Minsheng Securities Company's estimate that this could add approximately $27 billion worth of new gold demand into the market. Looking at major trends, Thompson underscores the unusual movement of gold from London to COMEX as a sign of a major market shift. He suggests uncertainty over Trump's potential return, and fears of gold tariffs may have sparked a rush to buy, with momentum driving prices higher. U.S. President Donald Trump warned of imminent new tariffs last week. These plans are broadly viewed as inflationary and capable of sparking trade wars, increasing demand for safe haven assets like bullion. Now we present the clips of Clive Thompson's insights from their recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Last year, there was something like 27 central banks acquired gold. They increased their gold holdings. And when you look down the list, with the exception of one, which is Poland, none of those central banks are the best friends with the USA. Over the last year or two, we've seen the United States weaponize the dollar, basically saying your bank balances are frozen, and not only that, we're going to pay your bank balances to your enemy. So when you weaponize somebody's dollars, it makes those people who are not the best friends with the United States think, well, do I really want to hold all these dollars? We haven't done anything wrong yet, but who knows how we're going to feel in a year or two. We have to have a plan B. And there could be a generalized move, I think, well, there is a generalized move by many central banks now to start acquiring some gold at the expense of treasuries. And, we see that in particular with China, where over the last year or two, 85% of the increase of China's reserves has been represented by the rise in the value of their gold holdings through two things. One, they've been purchasing gold, and that's been ongoing. And secondly, the price of gold has been rising. But they continue to buy despite the gold price being at an all-time record. So, reading between the lines, they don't really care what the gold price is, record or not record. They want more of it. So even though almost all of the increase in their reserves is represented by gold, they still want more because the amount of gold they hold per citizen is very small compared with that of the United States. It could well be a central buyer trying to hurry up, a central bank buyer, like China, for example, trying to hurry up and buy gold. But of course, the question would be, why would they buy in New York when they can buy in London? Well, perhaps they're buying in London too, we don't know. I suppose when you're in a hurry, You buy wherever you can get it. Of course, we've had Mr. Trump's election, and he's seen as a bit of a wild card. You don't know what he's going to do tomorrow. So that has increased the level of uncertainty, not only for investors generally, but also for central banks. They don't know what, when he opens his mouth tomorrow, what might happen. Maybe one of the catalysts for the rise in gold prices in New York over and above elsewhere was the threat of tariffs. Now, there's no reason why he would need to put tariffs on gold. I mean, the US gold mining industry isn't being dumped on. China or there's no country in the world shipping their gold to America at half price and dumping on America. I mean, they may be shipping their cars or their iPhones or their electronic goods and dumping that way, or their steel, who knows. But there's no way they're dumping gold, because the gold gets sold in the United States at exactly the same price as every other country. So there's no industry in the United States which needs to be protected. If they were to stop gold imports or put tariffs on gold imports, first of all, those countries that have got gold to sell would sell it somewhere else. It's easy to sell everywhere. And secondly, it wouldn't help the American gold mining industry, because they're not going to suddenly start opening a ton of new mines. And even if they do, it take decades for that to come on stream. It's not a nascent new industry which needs to be protected. There really is no need to protect America or Americans from foreign gold miners. So I don't think there's a reason to put a tariff on gold unless they just want to raise revenue for the American government. That's another story. But that could have been the fear that tariffs would come in, might have been one of the reasons which sparked off this initial flurry of gold buying. And then once the flurry starts, it can become self-fulfilling, because people say, okay, they might not put tariffs on, but the price is rising. I better get some, because you want to jump on a racing, on a moving train before it gets away from you. And I think, that to a very small extent, I think some investment managers are starting to look at whether they should have a little bit of gold in the portfolios.
In the interview, Clive Thompson explains that gold dealers usually hold reserves in London to cover short positions in New York, assuming easy shipment. However, a 4 to 8 week backlog at the Bank of England and LBMA has delayed deliveries, forcing short sellers to buy back contracts and pushing futures prices unexpectedly higher. For years, the Bank of England's bullion warehouse has been a trusted storage facility for precious metals, holding assets for central banks worldwide since 1697. The current flood of gold shipments has created bottlenecks in London, with the Bank of England struggling to keep up with withdrawal requests. Traders seeking to retrieve gold have, in turn, faced lengthy delays, prompting anxious calls to central bank officials. Gold prices have reached record highs amid concerns over trade policies. The price of gold futures in New York soared 11% this year to $2,909 per troy ounce. Analysts predict the price could soon surpass $3,000 per troy ounce for the first time. Moreover, Thompson speculates that a major player, possibly a central bank, is aggressively buying both spot and futures gold, driving prices up and disrupting normal market behavior. Let's get back to the interview.
A lot of the gold dealers, and these would be companies, hedge funds, banks, and others who play the COMEX market, would normally go short the future. So 2 months out, 3 months, they're shorted. But they're fully covered because they hold gold, or at least some of the gold, in London. Why do they hold in London? Because that's a great place to hold your gold and lease it out. The people who've shorted gold actually have no worries in normal times, because they think, we'll get to the current month and I'll just roll it over into the future month and nobody will ever ask for delivery. Never happens, or almost never happens, except it is happening this time. But they've got the gold in London, so the normal way of thinking is, well, if I have to deliver, I'll just ship the gold from London, convert the 400-ounce bars into 100-ounce bars, and within 2 days, I'll be able to deliver the gold in New York, except there's a hiccup. The Bank of England and the LBMA are facing a large number of requests for delivery of gold bars to New York, and there's a large backlog. The backlog could be somewhere in the region of 4 to 8 weeks now, which means that those people who are short on New York, they may be fully covered because they got the gold, but the problem is it's not in the right shape or size, not 100-gram bars, and it's not in New York. It's in London. They can't get it to New York in time. What are they being forced to do? They're being forced to buy back the contract that they shorted and roll it out for a future event, a future date, by shorting the future. Now, normally when that happens, you'd think that the contango would go to a backwardation. In other words, an unusual situation. You'd think the spot month would be higher than the future month because people would be buying the spot month and selling the future month because they can't get the gold and they have no choice. But that's not happening. Something completely opposite of what we're expecting is happening. The futures month is going to a premium to the spot month over and above what we would expect. So we're seeing the futures month, the contango, as it's known, trading, instead of trading at, let's say, $2 or $3 over spot for the February delivery, and there's only a few days ago in February, we're seeing $10 or $15 over spot, giving rise to a potentially extremely high return for those who do have gold bars, could hold the spot in New York and sell the future. But that should normalize. Normally that's arbitraged away within minutes. Why is that consistently higher than it should be? Well, what that means is there's a player in the market somewhere who's not only taking delivery of the spot, he's also, whoever it is, we don't know, buying the futures and pushing the futures up to an unreasonable premium over and above the spot, which makes no sense. It might become clear down the line what's happening. It could be people who are in the know saying, hey, there's a lot of shorts out there. They can't get their hands on the gold. We're going to squeeze them and we're going to buy spot and buy future, push the price of gold up and up to make them pay. It could be that going on. Or it could be that there's a major player in the market, like a central bank, who's quietly acquired a lot of futures in the past and now is surprising the market by taking delivery of more than usual futures instead of rolling them. And simultaneously, because it can't get delivery of all these bars in the spot month, is simultaneously buying more futures because they want to acquire a lot of gold in a hurry.
Ultimately, the continued buying by central banks and supply constraints in the mining sector offer additional support for a bullish outlook on gold. Will this trend accelerate further? And how will global markets react to the growing preference for gold over US Treasuries? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.